On the morning of the 15th of September, 2021, 5 minutes after the market opened, a man in Manhattan liquidated hundreds of thousands of dollars in call options. He'd held some for barely 48 hours. By 9:35 a.m., Puneet Dikshit, a partner at McKinsey Company, had turned roughly $23,000 into nearly $450,000. That afternoon, an internal McKinsey email noted Dikshit had been in the middle of the Goldman Sachs GreenSky deal for the last 2 years. No one knew he'd been betting on the outcome the entire time. Within weeks, CNBC flagged suspicious options activity. Within 2 months, the SEC traced every trade back to Dikshit. Within 4 months, a man earning over $1 million a year stood in a federal courtroom and pleaded guilty to securities fraud. The judge would ask him a question no one could answer. What were you thinking? This is how one of the smartest people in the room made one of the dumbest bets of his life. Dikshit grew up in India, earned a degree from Sydenham College of Commerce and Economics in Mumbai, then worked at Citigroup in debit cards and mergers and acquisitions. He later got his MBA from the University of Michigan's Ross School of Business in 2013, a launchpad into a career most finance professionals only dream about. He joined McKinsey as a summer associate and worked his way up through one of the most ruthlessly meritocratic institutions in global business. By the time he reached partner, he was leading McKinsey's North America unsecured lending practice and its digital payment service line, advising the world's biggest financial institutions. McKinsey partners earn more than $1 million annually. Dikshit had a family, a 5-year-old daughter, a 2-year-old son, a home in Manhattan. He had credibility, access, and the kind of professional trust that takes decades to build. And it was precisely that trust that made what came next possible. A call option is a contract giving you the right to buy a stock at a set price before a set date. If the stock rises above that price, your option becomes valuable. If it doesn't, you lose what you paid. Now imagine you know with near certainty that a stock is about to surge. You buy options out of the money when they're dirt cheap. If the stock jumps, your cheap bet becomes a fortune. That was Dikshit's setup exactly. In late 2019, Goldman Sachs engaged McKinsey to evaluate acquiring GreenSky Incorporated, a fintech company providing point-of-sale lending for home improvement and other consumer purchases. They codenamed it Project Glacier. Goldman granted McKinsey access to sensitive due diligence data, financial projections, valuations, confidential deal terms. The deal stalled during the pandemic, but by mid-2021, negotiations restarted. Goldman submitted a formal proposal on July 15. GreenSky rejected it. Goldman returned. McKinsey, with Dikshit leading, was asked to prepare updated acquisition documents. Almost immediately, Dikshit started buying GreenSky call options. His first purchases came August 6, when GreenSky traded around $8. He chose a strike price of 10, meaning the stock needed to climb 25% just to avoid expiring worthless. Throughout August, internal emails showed Goldman was moving fast. A final offer was imminent. Dikshit kept buying. On September 9th, a colleague told him Goldman had unofficially won the deal. A signing was expected Monday, September 13. Then came the brazen part. On September 13, from McKinsey's own internet network, Dikshit purchased hundreds of out-of-the-money calls expiring that same week. That night, he wired more cash into his brokerage. The next morning, he sold his longer-dated options and used the proceeds to load up on weekly calls, tens of thousands of dollars worth, expiring in days. By September 14, he held tens of thousands of call options. Most expired within the week. It was an all-or-nothing bet, except he already knew the outcome. Options markets punish abnormal volume with attention. On September 7th, GreenSky call volume was 153 contracts. By September 13, it had exploded to 12,755. CNBC flagged the anomaly within days of the announcement. Options trader John Najarian told the network, "When we see unusual activity like that, we tend to think somebody had tomorrow's newspaper today. Nobody's that lucky." Dikshit's digital trail was damning. On September 14, his McKinsey browser history showed he'd Googled "What happens to options when company is acquired?" A senior partner advising on billion-dollar deals, searching that phrase like a first-time retail investor. After CNBC reported the suspicious trading, Dikshit tried to get his trades retroactively approved by McKinsey compliance. He was denied. Then, in early October, his search history revealed something chilling. He'd begun researching the insider trading conviction of Rajat Gupta, McKinsey's own former managing partner, imprisoned in 2012 for tipping off a hedge fund with confidential Goldman Sachs information. He was beginning to realize he might get caught. McKinsey required partners to pre-clear personal securities trades. Dikshit never did. He traded through a commission-free brokerage and placed trades in his spouse's account too. None of it was flagged internally before the SEC intervened. McKinsey isn't a broker-dealer. It lacks the surveillance infrastructure of banks or hedge funds. Its compliance relies on self-reporting and honor. But Dikshit was the third McKinsey partner convicted of insider trading in Manhattan since 2010. This was not a new problem. Consulting firms sit at the intersection of power and information, advising on mergers, restructurings, and strategy, yet operate under lighter regulatory scrutiny than the institutions they serve. The assumption is that professionals will police themselves. When they don't, detection depends entirely on after-the-fact pattern recognition by regulators. On September 15, Goldman announced its $2.24 billion acquisition of GreenSky. The stock surged over 50%. By 9:35 a.m., Dikshit had liquidated everything. His personal positions, costing around $23,000, returned nearly $450,000. His spouse's account turned $1,500 into $26,000. Total illicit profit, over $450,000. On the 10th of November 2021, the SEC and the U.S. Attorney's Office filed charges. Dikshit was arrested at his Manhattan home. Bail, $1 million. McKinsey fired him immediately. On December 15, he pleaded guilty to securities fraud. On the 6th of April, 2022, Judge Colleen McMahon sentenced him to 24 months in federal prison. Dikshit stood in a gray suit in the courtroom. "I let down all the people who rely on me," he told the judge. McMahon was unmoved. She reminded him the trading profits amounted to less than 1 year of his McKinsey compensation. "It boggles the mind," she said. "Was it a game?" Then she said something broader. "Everyone out there thinks people on Wall Street cheat. I know people on Wall Street who don't cheat, but are tarred with that brush because of people like you." After the hearing, Dikshit's wife sat alone in the front row and quietly wept. Their daughter was 5, their son was 2. Dikshit, not a U.S. a citizen, would be deported to India after serving his sentence. The partnership, the career, the life in Manhattan gone. For $450,000 he didn't need. Greed doesn't fully explain this. He was already earning over $1 million a year. The illegal profit was roughly a few months of legitimate salary. Something else was operating. When you spend your career analyzing probabilities and advising on billion-dollar decisions, knowing the outcome of a market event with near total certainty must feel intoxicating. The temptation isn't purely financial, it's intellectual. Can I do this? His browser searches tell part of the story. He Googled basic options mechanics. He traded from McKinsey's own network. He didn't use a pseudonym or any meaningful concealment. This wasn't a careful criminal, it was impulsive. the behavior of someone who convinced himself it was a one-time thing, a victimless act, an acceptable deviation. Then the media reports came. Then the Rajat Gupta searches. Then the failed attempt to retroactively clear the trades. A slow, creeping awareness that the deviation had become a crime and the crime had become a trap. Puneet Dikshit was the third McKinsey partner convicted of insider trading in Manhattan in just over a decade. 3 partners, 1 firm, same courthouse. Each case differed in detail but shared identical architecture: a trusted professional, given access to market-moving information, choosing personal profit over institutional duty. The system depends on the assumption that people at this level will honor the boundaries that come with access. Most do. The ones who don't reveal something structural about how trust operates in modern finance. Trust is not a safeguard, it is a vulnerability. And when the only barrier between confidential information and a brokerage account is a compliance form no one checks, the system isn't protecting anything. It's waiting for the next person to decide the rules don't apply to them.